Hi, I'm Ross Mayfield, investment strategy analyst at Baird. 2024 has been a great year for investors so far, but it has not come without its share of uncertainties. A presidential election year, a murky path forward for inflation, and many more things weigh on investors' minds as we sit at the midpoint of 2024. That's why today I'm thrilled to present a Q&A with Strategas President and Head of Portfolio Strategy Nicholas Bohnsack to address all these questions and more. So without further ado, I'll turn it over to Nick.
How are you evaluating the current investment landscape?
As we move into the second half of the year, one of the most encouraging signs about both the US economy and indeed the global economy is that it seems to be broadening. While it may not be overtly strong, we are certainly seeing other participants, whereas the last year or so has largely been a story about growth technology and to a certain degree, the support systems provided by governments and monetary policymakers. So it's an encouraging signpost for us to see inflation remain relatively anchored, at least for the time being. It is an encouraging signpost for us to see a little bit of easing from monetary policy actors. Whether that guidance is misplaced or otherwise in the longer term, obviously we'll have to wait and see, but it certainly provides some bullish backstop in the time being. And most importantly, it's a very bullish signpost from our side of the aisle to see earnings strengthening and broadening out, margins expanding, and ultimately organic drivers of growth starting to manifest in an economy that has been reliant, as we mentioned a moment ago, too much perhaps on stimulus over the last number of years.
How do you see the path of inflation and interest rates evolving from here?
One of the things that we've been watching most closely since the onset of the pandemic several years ago has been the variability of inflation, and not just the rate of inflation that investor consumers are experiencing in their daily lives, but also the variability and volatility of inflation expectations. And there's a certain amount of satisfaction I think global policymakers, particularly monetary policymakers, can take in their adjudication of inflation over the last couple of years. It remains, for the moment, to be and appear to be well anchored. Certainly, we have started to see a global rate easing cycle emerge from Europe in particular, with signposts that the Federal Reserve will be joining the fray this fall. There is some latent concern, however, that inflationary pressures are extant and remain higher than at least the Fed would want them to be domestically. But ultimately, as a precondition for economic growth, the variability of inflation will inform the level of interest rates, and ultimately the big building blocks of stock prices have long been earnings and interest rates. So a lower interest rate framework should generally be taken as bullish for the equity markets.
What is your outlook for corporate profitability in 2024 and 2025?
When we think about corporate profits, I think it has to be taken as one of the sort of subtly most bullish items that we're looking at in the domestic landscape at the moment. The reason we say that is that for the better part of 2 years, really since the end of 2021 and right up through the end of 2023, corporate profits in the aggregate were actually range bound. They were bolstered on the one end by growth technology, artificial intelligence, and AI adjacent companies. But on the other end, we saw quite a bit of atrophy from other sectors. And that all really came to an end. In the first quarter of 2024, we saw corporate profits in the aggregate break out to a new cycle high. And it would appear that as the second quarter drew to a close, we saw follow-through strength, which I think needs to be taken as a bullish signpost. If we're looking at, say, any two indicators of underlying corporate profit strength, it's number one, that the trailing and actual earnings are starting to live up to the expectation and the estimate. And that has been the case now for the last three quarters. That gap has been narrowing, which is definitely a bullish signpost by our lights. And number two is that PEG ratios continue to move lower. So while estimate revision has remained upward, the expectant growth rates have continued to vector up with them, keeping those PEG ratios at acceptable levels. To put it in some perspective, Strategas believes that the S&P 500 will be able to grow corporate profits 8% this year in 2024 versus last year, and 10% next year in 2025 versus this year. So an accelerating growth rate with broader participation equates to a stronger earnings profile, and ultimately is the backdrop on which valuation and the stock market can move higher.
What are your highest conviction investment themes going forward?
I think it's interesting that while the last couple of years have been dominated by, at least in terms of market performance, have been dominated by just a handful of stocks, most notably the Magnificent Seven, albeit with some adjacent growth technology companies along for the ride. As we move into 2024 and out towards 2025, I do think a more granular portfolio construction may provide some ballast to a portfolio under the idea that the economy in and of itself is broadening. And so thematically, by our lights, there's really four places we think investors could find some opportunity when they start to look at the component parts. And not least among them is deglobalization, which, prior and unfortunately before Russia's invasion of Ukraine may have been more of an academic construct. This is really sewn together as being sort of an all-encompassing and almost dominant theme that we're very likely to be living with and living through over the next couple of years, if not a couple of cycles. And it's going to impact everything from supply chains, resource allocation, resource procurement, industrial technologies, and ultimately power. And so we're watching deglobalization very, very closely. I'd say the second two are perhaps resident more acutely here in the United States. And one is artificial intelligence, which certainly satisfies some of the early criteria for what we might deem organic drivers of growth. Now, AI may not be ready for prime time. The business use case may still very much be in development, but ultimately, corporate operators seem to be inclined towards putting quite a bit of their capital to work to try to understand how AI can be beneficial to their operations, and so that will very likely dominate the landscape in AI for the better part of this year, if not into next year, before we really start to evidence some of the productivity gains that can accrue when AI is put into place. And right alongside that, and not exclusive to AI, but more broadly, is our third theme, which is the industrial power renaissance. So much attention being taken on how we procure power, how much demand for power we have, what sources of power will ultimately be used. We think this has broken out as a theme unto itself, saying nothing of the power needs of artificial intelligence, but moreover, the global economy as it continues to expand. And industrial power renaissance may be the investment theme for the second half of 2025. And to round out the four, I think while the economy is broadening and strength remains, and even as global monetary policymakers turns toward easing interest rates, we still want to be mindful that the cost of capital is high. And so to the extent to which interest rates remain elevated, companies that have strong cash flow ultimately have stronger optionality. And so companies we deem cash flow aristocrats really have 7 things that they can do with their money. There are 3 outlets for returning capital to investors. You can do that through dividends. You can do that through share repurchase. You can do that through debt retirement. There are 3 outlets to try and achieve returns on capital, which is to say you can acquire another company for cash. You can engage in CapEx, or you can pay the labor you have more or hire more labor. And then tertiarily, the seventh outlet is retained earnings. We can take all of those decision points tomorrow. And so as the economy broadens, as the cost of capital remains high, companies with strong cash flow very much remain in the driver's seat of optionality. We would want to look to those operators as opportunities in portfolio construction.